So in the last video, you were introduced to the introduction of banks. And with banks, they're a member of the Federal Reserve System. They all participate in fractional reserve. So you have Big Money Bank and its balance sheet with assets in its respective categories and liabilities with its respective categories. Now let's see how banks create money with the fractional reserve banking system. So we have Abby, and Abby is a freshman at her new college, and she decides that she is not only going to get an apartment, she is going to take out a loan to pay for her new furniture. And Abby decides to go to Big Money Bank to apply for that loan. So if you recall, Big Money Bank has assets and liabilities, and let's look at the same amount that was used in the previous video of $5,000. But the reserve requirement is 10%, therefore 10% of $5,000 is $500. And in this case, the excess reserves will be $4,500. Okay. So out of this amount of $4,500, Big Money Bank can give this not only to Abby, but to anyone that would like to come in and receive a loan. However, Abby is more conservative with her funds, and she decides that she wants to have $1,000. So Big Money Bank would place on their balance sheet that they have given Abby $1,000. However, this does not change the composition under liabilities because it is still representing that initial deposit of $5,000. Therefore, the required reserve still stays at $500. So, where does this $1,000 come from in order to balance with the $5,000 under liabilities? It must come from excess reserve. So, excess reserve is going to decrease by $1,000. And now, excess reserves is going to be $3,500. And the reason why it's down to $3,500 because $1,000 was pulled to give Abby a loan. Well, let's say that the bank decides to encourage Abby to deposit her loan amount back into their bank. And Abby decides, why not? It makes banking much more simpler for her. So when this occurs, Abby's deposit of $1,000 is added to Big Money Bank's new balance sheet, and instead of liabilities being $5,000, it's now $6,000. Because Abby deposited back into Big Money Bank's account. However, the required ratio is still 10%. Therefore, instead of $500 now being reserved, it is now $600. Abby has yet to pay off the loan, so Big Money Bank must still have on their record $1,000 for the loan. But if you recall, this sheet or T-chart must balance. So how much are excess reserves? If you guess the amount, $4,400, you are correct. Now, Big Money Bank, they realize that, hey, we're doing pretty well with handing out loans to individuals. Let's continue this practice of giving it to individuals who we believe that can pay it back. And Corey decides that he wants a $2,000 loan from Big Money Bank. And when he receives this loan from Big Money Bank, he deposited into, you guessed it, his account at Big Money Bank. And now the liabilities for Big Money Bank has changed to $8,000. The required reserve is still 10%. Therefore, the required amount is $800. And for loans, we now have $3,000. Because it represents the $2,000 that Corey took for his loan from Big Money Bank, and it represents the $1,000 that Abby pulled out for her loan. So what would be the remaining amount for excess reserves? If you're one of those math all-stars that don't need a calculator like me, the amount would be $4,200. And as you can see with this process, the money making continues and continues until the fraction has established itself or there is no more money left to be loaned out from the bank. So it's important to know that this practice is a continuing operation of all deposits and withdrawals, not only with Big Money Bank, but with all banking institutions. If Abby had decided to deposit her entire loan amount in another bank that is a member of the Federal Reserve, it would be the exact same thing. However, it is important to note that credit unions are not regulated by the Federal Reserve, nor are they insured by the Federal Deposit Insurance Corporation. Only banks that are regulated by the Federal Reserve are insured and backed by the Federal Deposit Insurance Corporation. Credit unions have their own regulatory agencies, and the primary one is the National Credit Union Administration, which is a government agency. So let's go back to Big Money Bank. Eli, he took out a $3,000 loan from Big Money Bank, and he has now decided to deposit that $3,000 into his bank account at Big Money Bank. So once again, we still have the reserve requirement of 10%. Therefore, the reserve requirement is now $1,100. And the loans, which includes the $1,000 from Abby, the $2,000 from Corey, and now the $3,000 from Eli, will give you a total of $6,000. And the excess reserves, $3,900. So we mentioned earlier that this process would continue over and over and over until the money runs out. So how will you be able to determine how much money is created as a result of the initial deposit of $5,000? Well, that is where the money multiplier comes in. Let's erase that. And the money multiplier is the amount of money the banking system generates with each dollar of reserves. So the money multiplier establishes how much the money supply can be expanded with an initial deposit. And it is calculated through the formula of 1 over R, which represents the reserve ratio, or 1 over RR. You may see this in some of your assignments or on other activities that are online. Therefore, in our example, the reserve requirement was 0.1 or 10%. Therefore, you would calculate the money multiplier with 1 over 0.1, which gives you 10. Now, this number 10 does not represent a percentage, It just represents the number of times that the money supply is going to be expanded when it is multiplied to the excess reserves of that initial deposit. So in our example, the initial deposit was $5,000 and 500 of that is required to stay in the bank vault. Therefore, that $4,500 represents the excess reserves that is multiplied to the money multiplier, which is 10, giving you a grand total of the maximum amount of the money created of $45,000.